Hello, everyone, and welcome back to Financial Podcast. I'm your host, Olivia, and I'm really excited to dive into some key economic data that just came out, specifically the latest report on U.S. consumer confidence. This is a crucial indicator because it gives us a snapshot of how average Americans are feeling about the economy, their jobs, and their financial futures. And those feelings can have a significant impact on spending, which in turn drives a large part of economic activity. The big news this month is that the U.S. Consumer Confidence Index, as measured by the Conference Board, saw a notable increase in May. The index climbed to 98.0. This reading was significantly better than many economists had anticipated, as the consensus estimate was around 87.0. Not only did it beat expectations, but it also represented a substantial jump from the previous month's reading of 85.7, which was a nearly 5-year low. This improvement is particularly noteworthy because it brought an end to a period of 5 consecutive months where consumer confidence had been declining. This prolonged slump had pushed the index to its lowest point since the very early days of the COVID-19 pandemic. So seeing a rebound, and one that was stronger than expected, is certainly a positive development that has captured the attention of market watchers and policymakers alike. The Consumer Confidence Index is made up of two main components. The first is the Present Situation Index, which reflects consumers' assessment of current business and labor market conditions. The second is the Expectations Index, which gauges consumers' short-term outlook, typically over the next 6 months, for income, business, and labor market conditions. Both of these components saw movement in May. The Present Situation Index increased to 135.9, showing an improvement in how consumers viewed current conditions compared to the previous month. Meanwhile, the Expectations Index saw a much more dramatic surge, jumping a significant 17.4 points to reach 72.8. This sharp rise in expectations was a major driver of the overall confidence increase. However, it's important to note that despite this significant gain, the expectations index remained below the threshold of 80. This specific level is often seen by economists as a point below which there can be signals indicating a potential recession ahead. So, while consumers became much less pessimistic about the near future, the reading still suggests some underlying caution about economic prospects down the line. According to reports on the data, much of this newfound optimism among consumers appears to be linked to developments on the international trade front, specifically the easing of trade tensions, most notably between the United States and China. The news of a trade truce between the two largest economies in the world, which included the slashing of some tit-for-tat tariffs, occurred earlier in May. This trade agreement between the U.S. and China wasn't the only factor, however. The sources indicate that President Trump's administration had already been taking steps to soften some of its previously imposed tariffs. Weeks before the China deal, the White House had paused broad reciprocal tariffs that affected imports from dozens of countries. There were also instances of easing sector-specific tariffs, such as those targeting automobiles, and rolling back duties on certain goods coming from Mexico and Canada. This context of easing tariffs is crucial because tariffs, or import taxes, had been a significant source of anxiety for consumers and businesses in the preceding months. Businesses, especially major retailers that import goods from various parts of the world, had been warning consumers about the potential for price increases due to these levies. Several prominent retailers, including names like Nike, Target, Walmart, and Best Buy, had openly cautioned about possible tariff-driven price hikes across a range of products. For example, the CEO of Walmart, Doug McMillon, was quoted as saying that tariffs create cost pressure for the company and risk increasing prices for a wide variety of goods, from food and toys to electronics. The scale of the tariff impact prior to these recent rollbacks and pauses was quite significant. One analysis, mentioned in the sources, conducted by the Yale Budget Lab, found that consumers were facing the highest overall average effective tariff rate since 1934. And this highlights just how substantial the burden of these import taxes had become on the cost of goods purchased by consumers. While some tariffs have been eased or paused, it's also important to understand that not all of them have been removed. According to the sources, an array of tariffs do remain in place. This includes a general 10% levy that applies to imports from nearly all countries. Additionally, specific tariffs continue to affect items such as auto parts, as well as steel and aluminum. So while the recent actions provided relief, the tariff landscape is still complex, and these remaining duties could still influence prices and consumer sentiment to some extent. The rebound in consumer confidence in May wasn't confined to specific groups. It was described as broad-based, taking hold across all age and income demographics surveyed by the Conference Board. This indicates a widespread improvement in sentiment among the American population. Interestingly, while optimism increased across the political spectrum, the strongest improvements were noted among Republicans. Beyond the headline number, the survey provides more granular detail on how consumers feel about specific aspects of the economy. Views on the labor market, for instance, showed signs of improvement. A higher percentage of respondents expected more jobs to be available in the next 6 months compared to the previous month, and a smaller percentage anticipated fewer jobs. However, the picture regarding the current job market was slightly mixed. While the percentage of consumers saying jobs were plentiful edged slightly higher, the proportion saying jobs were hard to get also increased modestly. So, while the outlook for future job availability improved, consumers' assessment of the ease of finding a job right now softened somewhat, even in the context of generally strong national job reports. Another area of improved sentiment was consumers' outlook on stock prices. With the stock market showing signs of recovery in May, the survey found that a larger percentage of consumers expected stock prices to increase over the next year compared to April, and a smaller percentage expected them to decline. This shift in investment outlook reflects increasing risk appetite among consumers as their overall economic sentiment brightened. Looking at personal finances, consumers' assessments of both their current family financial situation and their expected future financial situation showed improvement in May. This suggests that the increased optimism extends beyond just the broader economy to help people feel about their own household finances. The survey also asked consumers about their perceived likelihood of a U.S. recession occurring over the next 12 months. Following the overall trend of moderating pessimism, the share of consumers who expected a recession declined in May compared to April. This reinforces the idea that the easing trade tensions and the rebound in confidence have helped to alleviate some of the recessionary fears that had been building in previous months. Consumer purchasing plans also saw a boost in May. Intentions to buy homes, cars, and take vacations all increased notably, with some significant gains reported after the May 12th U.S.-China trade deal announcement. Plans to purchase other big-ticket items, such as appliances and electronics, were also up. Furthermore, consumers indicated increased intentions to spend more on services in the months ahead, with categories like dining out, streaming services, movies, theater, live entertainment, and sporting events seeing particular gains in spending plans. The Conference Board survey included some special questions this month to delve deeper into consumer behavior and concerns. One set of questions asked consumers about recent changes in their spending and financial habits. Interestingly, a significant portion, over a third, indicated they had put money aside for future spending. Around a quarter said they had dug into their savings to pay for goods and services, and a similar percentage reported postponing major purchases. These behaviors, however, showed notable differences based on household income levels. Consumers in higher income households, those making over $125,000 annually, were more likely to report saving money, while those in less wealthy households were more likely to say they had used their savings or postponed major purchases. This highlights how economic conditions and concerns can have varying impacts across different income brackets, with lower income households potentially feeling more immediate pressure on their budgets. Another interesting finding from the special questions related to consumer worries, when asked about their anxieties concerning being laid off, not being able to afford necessities, and not being able to afford desired goods and services, consumers expressed more concern about affordability than about job security. Nearly half of consumers reported being worried about not being able to buy the things they need or want, which is a significantly higher proportion than the less than a quarter who were worried about losing their jobs. This finding reinforces the idea that while the job market has remained relatively strong, the issue of prices and the ability to afford goods and services has been a more prominent concern for many consumers. While there were some mentions in the write-in responses of easing inflation and lower gas prices, tariffs increasing prices and having negative economic impacts were still reported as being on top of consumers' minds. The increase in consumer confidence has important implications for the broader economy. Consumer spending is a critical component of U.S. economic activity, accounting for roughly 2/3 of the nation's GDP. When consumers feel more confident about the economy and their own financial situations, they are generally more willing to spend, which can provide a boost to businesses and contribute to overall economic growth. Conversely, a slowdown in consumer spending, perhaps triggered by worsening sentiment, could potentially harm businesses, leading to outcomes like layoffs. These layoffs could then further reduce consumer confidence and spending, creating a negative feedback loop that slows down the economy. The rebound in May suggests that this potentially negative cycle was interrupted, at least for the time being. For the markets, the improvement in confidence is generally seen as bullish. More optimistic consumers tend to support higher retail sales, which can translate into stronger corporate earnings. This, in turn, can provide positive momentum for equity markets. The rise in U.S. consumer confidence in May was indeed accompanied by a surge in the stock market, as mentioned in the sources. Furthermore, improved sentiment can influence demand for different types of assets. As investor risk appetite increases with brighter economic prospects, there tends to be reduced demand for safe haven assets, which are typically sought out during times of economic uncertainty. Assets like government bonds and gold are often considered safe havens, and reports noted that spot gold prices fell as U.S. consumer confidence rose. Stronger consumer sentiment can also factor into discussions about monetary policy. If this rebound in confidence is viewed by central bankers and market participants as a sustainable sign of economic strength, it could potentially support arguments for maintaining or even gradually tightening monetary policy. However, if the optimism turns out to be fragile, or if other economic pressures such as persistent inflation or geopolitical instability reemerge, it could alter the policy outlook. Despite the positive news, some economists caution against interpreting this 1 month's data as a definitive signal of a sustained upward trend. They point out that the improvement in confidence needs to be matched by concrete improvements in areas like wage growth and consistent job creation across all sectors for increased spending to be truly sustainable. If these underlying economic fundamentals don't keep pace with the jump in sentiment, spending might remain limited despite the brighter mood. Additionally, ongoing factors such as rising yields in financial markets and continued geopolitical friction around the world could still weigh on consumer behavior over time. While the recent easing of trade tensions was a significant positive driver for May's confidence, the global economic landscape remains subject to various potential shocks and uncertainties that could quickly shift sentiment again. So while the surge in U.S. consumer confidence in May was a welcome surprise and signals a potential moment of resilience in the economy, whether it marks the beginning of a durable new trend or simply a short-term bounce remains to be seen. It's certainly a positive data point for markets and policymakers looking for signs of underlying economic strength, but continued monitoring of future reports and broader economic indicators will be necessary to confirm the trajectory of consumer sentiment and its impact on the economy. That's all for today's episode of Financial Podcast. I'm your host, Olivia, and I'll see you next time.